Actually, I'm not going to talk about this slide. I've just put it up for you all to have something to look at while I talk about something totally different. And I think it's a little bit of a shame that we got to talk after lunch without people having coffee in their system. So I hope you can sort of stay awake for my presentation, which will have only but 2 slides. This one as a bit of background for you all to look at if I get boring, and another one that's actually related to what I'll talk about. I'm going to be speaking about the sort of impact that private sector engagement has had in addressing issues that are either single-handedly about one of the dimensions of the nexus, or in incredibly rare cases are thinking about the nexus in a joined-up way, both from the perspective of why did any of these things happen, what is the role of public policy in having helped to facilitate that or not, and what are the key limitations to us thinking that the private sector can really be the kind of game-changing actor in terms of these things. First, with a bit of context, which I'm sure you all are all appreciating in your work already, ODA all around the world is going down. And increasingly rich countries amongst their own populations are considered pretty poor. So there's an increasing need and demand, particularly upon developed OECD countries, to either ring fence or significantly diminish, at least in the United States, I can say that for a fact, the amount of foreign development assistance. Now, this sort of raises real questions when thinking about development as to where the financing is going to come from. I would suggest in the climate change space, this is fundamentally a shift toward people looking at the private sector to fill in the gap of capital investments into low carbon technologies. That kind of a shift in terms of the shift of burden, as it were, from rich country governments to private capital is one that I would expect to extend out to a lot of other areas. And so from that perspective, I think the question about what the private sector can do is particularly timely, and the question of what the private sector can't do and thus needs to get incentivized either through regulation or gets filled in through public capital effectively. The fact that this is a big part of what this study is doing, I think is quite important. The other thing that is sort of contextual, I would suggest, is in the context of this recession, a real challenge in terms of private capital movements because of a kind of crunching of liquidity in the capital markets. And so despite the fact that FDI is starting to flow in some areas, and we're seeing a little bit of a kick in 2010, capital markets are really, really constrained, and a lot of large-scale infrastructure projects in many parts of the world, including sub-Saharan Africa, but others, have been put on hold because of lack of access to capital from the international markets. So that is a conceptual thing. I wouldn't want to bet my life on whether or not that's going to get better in the next couple of years, but I suspect it probably won't. And then the final one, which I think is critical for when thinking about the private sector, is around new sources of capital. So a lot of the movements, I suspect, in what we've seen in sub-Saharan Africa are a reflection of where Chinese and Indian capital is going. And so when thinking about the big question about what can private capital do, within that are sovereign wealth funds, at least in our conception, sovereign wealth funds and state-owned enterprises. So that includes all the Middle Eastern funds who are incredibly wealthy with the oil price at the moment, as well as China that's sitting on a gigantic amounts of money that is actually looking, interestingly, to invest externally rather than internally. So that's $3 trillion of quote-unquote private capital, which is actually state capital in that sense, that should get integrated into our conceptions of, okay, well, how do we move the market on private capital flows? So those are all contextual things. Starting off on private sector, what I would say is that sort of our conception would want the private sector to have a relatively broad definition. So in addition to multinational corporations, I think I would suggest that we talk about private capital markets in general. So that moves us into the sort of level of the way in which institutional investors think about their investment flows, basically the people that provide debt and equity financing to these large multinationals. More and more, we're finding that kind of institutional level is more and more interested in natural resource issues because they are of concern. And so there's a lot of work, particularly in the climate space, that's been done with institutional investors who have a very different set of reasons as to why they care about these things. For them, they have what we call patient capital, capital that is meant to sort of earn returns not over 1 or 2 years, but over 30 or 40 years. And that means that their relationship to issues like climate change are quite a bit different because they're along a similar set of time horizons. They're increasingly becoming interested in water. So, for example, through the Water Disclosure Project, institutional investors are thinking about the water exposure of all of their investments. So that means through their own value chain, through the companies that they invest in. In addition to that, I would suggest that it extends out, as I mentioned, to new sources of capital from China, India, and the Middle East as being quote unquote sort of private, in addition to sort of smaller and medium scale enterprises, and then the kind of interplay that exists between the public and the private in what could be considered hybrid sort of structures. Now, for example, all of the market mechanisms that exist around climate change could arguably really be these kinds of hybrid structures, whether it's the clean development mechanism, the European trading system, these kinds of sort of elements in which effectively the public policies created a new marketplace in which large and small scale private actors have to play is part of the kind of dance that needs to happen, because as I'll get into more detail, it is those kinds of quote unquote hybrid regulatory driven structures that in our experience have proven to be more effective in dealing with public policy issues than sort of, independent private sector driven initiatives, though they are clearly important. It's a very good moment for us to be addressing and thinking about those private sector initiatives, not only because of the facts that the sort of challenges for public capital that I mentioned earlier, but also because we now have about 20 years of experience in thinking about them. Even before Rio Plus 10, I would suggest that there were already private sector actions in order to address a lot of these issues. So we now have a sort of I wouldn't suggest a critical mass, but we have a lot of data to be looking at, particularly, I would say, from the climate change space, from forestry, from water, and to some degree more and more around things like food. So that's a sort of overall definition. I'm going to table for now market-related subjects, which I think are getting addressed in a different chapter, but again, have that dance with private sector that I think are incredibly important. So trade regulations, incredibly obvious, but super important to the way that private capital moves around. Subsidies. I can't talk about subsidies wherever I go enough. The amount of money that we spend in fossil fuel subsidies in single countries, in some cases, is nearly as much money as we would need in climate finance for renewables all around the world. So the fact that we still have these subsidies, that's not even talking about food subsidies, means that we are inherently distorting the markets for all of these choices. Of course, then the private sector makes certain choices. And so what I would suggest is even though resource scarcity is going to be a big driver of private capital movements, if we don't get the pricing right, it's going to move in the wrong direction anyways. So particularly in the case of water, which is totally priced incorrectly in all places. I don't think there's any example really of people having an accurate water price in most contexts, particularly in developing countries. And so if we agree that for a lot of these resources, the pricing is already wrong or is subsidized and distorted, how would we expect the private capital would move into these areas in a better way if we don't deal with subsidies and the other distortionary sort of parts of the system? So that's sort of an overall look at, sort of the private sector. Let me go through a couple of the things in our experience that have been the most important in terms of driving sustainable private sector action that is in the kind of zone, I think, Karen, of what you're looking at. So multinationals, why they do things that are that meet these kinds of objectives. The first would be what isn't sustainable. I would maybe controversially suggest that CSR is not sustainable. That CSR is what is conceived currently as CSR, corporate social responsibility, around things that are driven by things like employee motivation, brand recognition, or by single members of leadership teams, are not actually long-term sustainable motivations for businesses. What we have seen is that CSR departments get axed when they're in the middle of a recession. These departments usually report into marketing, which is one of the first things that goes when you're having a constrained sort of working environment. On the other hand, the things that have worked, and I have probably 5 or 6 conditions of things that have worked, are integrated policies within companies that are within the operational apparatus. They don't report in to marketing, in short. You're dealing with people who effectively have a profit and loss statement that they need to achieve every month, and this matters to them. The reason why many of these things matter is because they need the good. So almost all the companies that we've just seen who are beer manufacturers or chocolate manufacturers or whatever need water to get the job done. They're noticing that in the places that they are trying to get the job done, increasing trends of water scarcity, one, and conflicts with other people who might need that water. It then becomes a business imperative for you to sort this out. It also is a good marketing ploy and a very valuable exercise to get other companies to think about the same thing. The second reason would be market opening, so all the bottom of the pyramid kind of stuff that people talk about. So going into either rapidly emerging markets or markets that will do well into the future, this is in real business interest to get your foot in the door and to be able to sell products to consumers in new places. There's another example of looking to achieve competitive advantage by having higher standards yourself. So you see this more in OECD countries, I would suggest, but multinationals who have already achieved incredibly high standards can then push other people out of the market by having a regulatory sort of level that they achieve but their competitors can't achieve. So that's one of the other reasons why companies take on these kinds of partnerships. Another one is building relationships with NGOs and governments. These things sometimes just serve as a platform by which, in a sort of calm and uncontroversial environment, all parties can have a sort of heart-to-heart conversation, and companies can have an opportunity to sort of share their perspectives on public policy issues. And then there's the last and final one, which is that a lot of the sort of, I would say, UN Global Compact-ish kinds of partnerships, which are about creating learning networks. And so businesses in one industry or one part of the world can share their experience with other businesses. And again, these are important for those things that are not competitive in terms of these kinds of regulations. So those are the 5 different sort of motivations that I think we've seen to be sustainable across the private sector community as defined as multinationals. Again, you would find different sets of motivations, or additional, I would suggest, sets of motivations for the capital markets in general, so the sort of bigger fish, equity and debt providers, as well as for new sources of capital. The way that the Chinese and Indian capital sort of relates to these kinds of issues is really quite different, and we have not yet seen these types of initiatives with those sources of capital, and I suggest if we wanted to, the way that they would work would be totally different. Some variations across industries and across companies as to why some participate and do these kinds of things across those principles and some don't. The biggest one I would suggest is brand. So again, if I refer you back to the sort of image that we had before, maybe you chose brands because then we would know those companies. But when you look at it, a number of, if not the vast majority of these different kinds of partnerships, most of the companies that are engaged in it are big brand companies. And it is because it's a combination of competitive interest along the lines that I suggested, as well as a real push by these companies to look good to their consumers. The challenge with it being branded and not branded, well, there are a couple. One, it means that you don't have the same type of motivation for non-branded companies. So that's a massive challenge for those who are not consumer-facing. The other one is that you don't necessarily having a branded company do this for brand reasons means that you need continued public scrutiny on companies in order for them to ensure long-term interest in these things. If over time public interest changes in certain contexts, that kind of activity won't be sustainable, or again, talking about Chinese and Indian investments, or Brazilian investments for that matter, maybe there isn't public scrutiny of those investments at all anyways, even if in those countries they represent big brands. So I think our experience so far is of course brand may be a sort of entry point of discussion with companies as to why they might do these things, but it is a very, very fragile one. And it has to extend down to business reasons in order for it really to be sustainable. And you can see over time the progress of a company like Nestle or Unilever from the sort of start off of having something being driven by consumer pressure into something that is recognized and understood as a big part of their business interest. And that sort of progress takes quite a bit of time. In addition, I would suggest, because of these limitations, and again, the need to sort of shift private capital to addressing these kinds of issues due to their footprint, if not due to the sort of lack of public capital, we absolutely need to think very smartly about the role that public regulation plays and public scrutiny. And so there, in addition to thinking about these kinds of type 2 partnerships or sort of multi-stakeholder platforms, of which there are many, many more than the ones discussed here, we also need to be, in thinking about this issue, need to think about the role of critical civil society organizations all the way up to national policies that change the regulatory frame in which private capital operates. Changes in the regulatory frame at the international level, as we know, are very, very difficult. Just looking at the climate change space, we may well be losing the clean development mechanism. We're having a massive gap in it this year, so that one of our premier hybrid public-private mechanisms may be losing steam, which is very disconcerting. So, you know, putting all of our baskets in international regulation or even domestic regulation doesn't seem like a safe bet currently for a lot of these issues. Not to say that that isn't actually where most of the sort of sustainable progress will need to come from. In terms of a critical sort of NGO community, for a lot of corporations, if they are one of the reasons why branded entities are concerned about their activities. So if we didn't have organizations like Greenpeace telling beef producers in the Amazon or sort of showcasing the impacts on deforestation, we wouldn't have had the shift that we did have there. So, you know, there's been two massive moratoria in the soya industry as well as the beef industry for fundamentally non-branded firms, which were, I would say, almost single-handedly driven by a massive Greenpeace campaign. Now, that kind of effort, why it is required for those kinds of companies. Public scrutiny is more and more important, and thus finding a way to ensure that these organizations exist and have the resources that they require is going to be particularly important. So that is, I think, the kind of landscape. Again, a very, very important and timely issue in which I think we need to be quite realistic in what private organizations can do and what they can't do, and what we can think about for two quote-unquote new areas, whether it's sort of the larger capital markets or new sources of finance, ways in which they get further engaged into this question. And I'm trying to shoehorn in one little thing, which is what the next slide is about. And that's looking at some of the results of the research that we've had on how the nexus is going to impact political stability. It's one of the things that's not explicitly covered in the report, as I can tell, but is something that, for a number of different reasons, is of real interest, and maybe one of the reasons why a lot of governments take the nexus seriously. So if you'll bear with me, this is a very simple diagram, slightly better than the last one, around the kinds of things that are going to be, in our perspective, are going to have political stability implications or have already started to. So the ones in red are the ones that represent higher costs, and higher costs that will most affect lower income populations. So increased food prices, increased transportation prices, and increased electricity costs. This is just a look not at all of the dimensions of the nexus, but looking at what will come out of our expectations of energy resource scarcity dynamics. So this is about what's going to happen in the fossil fuel space. So on the oil side, I can get into a huge conversation about why we think oil prices are going to generally trend upwards over time and be increasingly volatile. In the coal space, until the market matures, coal prices will do exactly the same. And in the gas space, there is a huge amount of uncertainty because of unconventionals. At minimum, what I can say is that older, sort of more traditional suppliers are going to have diminishing influence in the gas markets. The implications of that, as I said, the first three are increased costs, hugely impacting for developing countries. The second is around increased financial flows. So we would go a little bit farther than land. Of course, there will be increased investment in land for a number of different reasons, food and biofuels production for sure, as well as increased investment in oil in higher risk contexts. So we're seeing movements into much smaller fields that may not have been economically of interest before, and surely increased investment flows from what would previously be considered risk-adverse investors into high-risk contexts. I'm almost done. And then finally, increased investment for coal for export, which is hugely important for a lot of countries that are choosing to become reliant on coal imports. The final one, which is the most destabilizing of all of these, is the impact on government subsidies for fuel and for food. This is what we saw as, of all of these reasons, the one that was the most important in the Arab Spring was the impact on subsidies. And we do not expect this impact on subsidies to go away at all, given the huge fiscal exposures that developing countries have to these kinds of price controls, and heightened inflation, which is macroeconomic. I think the reason why I wanted to shoehorn this in is to say that there are political stability implications to the nexus and resource scarcity in general, which we see as being one of the key drivers why some developing countries are going to make a move, at least on subsidies first, because they're already feeling the pinch around making, continuing to have those programs. And it's an issue generally of interest because I think Europe is concerned about political stability implications of anything that happens in North Africa. So with that, a little shoehorn in, but thank you for listening.